Yeah, the deadline so close at this time, and obviously there are going to be implications for the economy going forward. But we still got that rate hike earlier this week from the MPC. Let's drill down on how that's impacting the commodities market. Now, we have joining us Dr. Desola Sumoni, Senior Associate Financial Derivatives Company, join us via Zoom. Great to have you. Good morning.
Good morning, Laddie. Thank you for having me on the show.
Yeah, so Adesola, I know you don't have any problems exchanging your old notes for new ones. You're way over there in the UK, Adesola, so good for you, right?
I mean, I do have some Naira notes here in the UK. I mean, just to, just some like maybe 20K or 50K thereabout, but It's not a big deal. I've accepted it as sunk costs. I cannot exchange it, but most of my trade is online. I think yes, the deadline is coming closer a few days from now, and there's still a lot of I think there's going to be a lot of rush to the banks to exchange the old Naira to the new Naira notes, as the central bank governor said. We're not changing. We're not shifting the deadline, even though to start with, the deadline was short, to be honest. But the central bank has said we're not going to shift it. And there's going to be a lot of rush, there's going to be a lot of commotion in commercial banks in the coming days, but also in the foreign exchange market, with people either buying dollars or trying to exchange their old Naira notes.
Well, but there's that 50 or 20K that you still have there with you. You need to find a way to get it over here to me. I'm not going to let that go. But let's talk about the recent rate hike there by the MPC. We've had mixed reactions. Trail it is about 17.5% now, and obviously we saw the T-bills rate actually fall. But when you look at, when the U.S., raises rates, we see the U.S. dollar, that always reacts positively to that. We had that massive run, in 2022, but it's not the case with the Naira. Why is that?
In a host of factors, like first of all, the rate hike came as a surprise to most market watchers, and most analysts expected monetary policy parameters to remain unchanged. Or even if they're going to hike, we should have seen maybe a 50%, a 50 basis point hike in benchmark interest rate. But they went all the way to 100 basis points, which came as a surprise to everyone, me included. But I think it's just the central bank trying to signal that they mean business with inflation. That try to signal confidence, or try to signal their commitment to fighting inflation. And this has a host of implications. But let's look at cumulatively in the past 10 months, Laddie, the central bank has increased benchmark interest rate by 600 basis points, which is essentially 6%. But inflation has only declined by 0.13%, which for me suggests that maybe some of the key drivers of inflation are not primarily monetary factors, or there is a breakdown in the transmission of monetary policy from the benchmark interest rate to actually affecting prices. Also, like you mentioned, the T-bills, usually the benchmark interest rate is kind of like a signal, right, for the market that, okay, now we are going to increase a signal, or to anchor expectations, interest rate expectations in the financial market. So with the interest rate at 17.5%, which is, I think, a 15-year or 17-year high, all other interest rates in the market should follow suit. But we are not seeing that, to be honest, Laddie. If you look at, like you mentioned, the Treasury bills rate, we saw a 91-day Treasury bill rate at 2%, 182 Treasury bill stop rate at 4%, and a 1-year Treasury bill note study is 7%. Meanwhile, benchmark interest rate is 17.5%. So we see that big mismatch. We see that it appears that other interest rates in the economy are not trailing the benchmark interest rate. To me, that suggests there's some breakdown in the transmission of monetary policy.
And if we look at inflation in the Eurozone, in the US, we've had that downtrend, with the rates in those countries, and you would wonder, is it the rate hikes that actually bringing those inflation rates down, or is it just energy prices actually going down and food prices in the global market?
A host of factors. So first of all, they are not comparing apples to apples, right? They are comparing apples to oranges, right? So the monetary policy, the transmission essentially of monetary policy in the US, the UK is quite stronger, or is better than in Nigeria, which is a developing country. But like you mentioned, the US has over the past 10 months, they've increased their benchmark interest rate by around 4.25% cumulatively, and inflation rate has responded by declining by around 2.6%, which kind of shows that inflation is responding to the hike in interest rate. But apart from that, we're also seeing some of these bottlenecks that reduce supply, that makes too much money pursue too few goods, according to Econ 101. We see some of those supply bottlenecks ease. We're also seeing energy prices, food prices also ease a little bit, and those factors are contributing to they're contributing to the decline in inflation. But you mentioned something, and at this point, it's quite difficult to to predict the pace of monetary policy, at least in the US. There's so much confusion, and at this moment, it's a mixed bag. Like I mentioned on Tuesday, Ladi, market economists see a smaller pace in interest rates hikes, while the US Fed officials are seeing a higher pace. So there's this mismatch, and it's confusing the market. On one hand, some officials are giving comments that give like dovish comments. On the other hand, some other officials are giving hawkish comments. So it's a bit of a mixed bag. But what at the bottom line, Ladi, is that inflation is responding to hikes in monetary policy rates in these developed economies.
All right. How would this the recent hike, how would that impact the domestic commodities market here in Nigeria?
Okay, so one of the immediate impacts of the hike in interest rates is that, first of all, increase the cost of credit, right? So it's more difficult to get money. It's more expensive to borrow money, which kind of limits, strengthens Naira, right? And it limits the amount of it limits spending in a way, right? So that's kind of has some effect on domestic commodities markets, in the sense that, one, the Naira strengthens, but that also affects, reduces demand, right, which would kind of ease pressure on the domestic commodities market. But as at now, and for the near term, there's no change, because inflation is really sticky, or prices are sticky, right? Meaning that they're quick to rise up, but they're very, very slow to come back down. So we are still going to see prices still remain high. You are still going to pay 38,000 Naira for a bag of rice, right? You're still going to pay 20K for a bag of 50 kg bag of flour. You're still going to pay 16,000 Naira for a 50 kg basket of tomatoes. So prices are still sticky, but hopefully they're going to trend downwards. We expect that they're going to trend downwards. Headline inflation will trend downwards, but prices are still a little bit sticky.
And obviously, when the rates were hiked in the US, obviously we saw the equities market in 2022 reacted negatively to that. We saw, sell-offs with the tech-heavy NASDAQ. But in Nigeria, the equities, the local bourse, that went up, was best performing fourth globally. But now, with this rate hike we had on Tuesday, we've seen the market decline in two sessions. What's that telling us?
So Econ 101 will tell you that there's a negative relationship basically between interest rates and stock markets. Essentially, when we see hikes in interest rates, typically the stock market closes lower. One key reason is because it, first of all, increase the interest expense cost of companies, which then affects their stock price. And if many companies also have like huge debt, then that knock-on effect of the increase in interest expense pushes down stock prices. So that's part of why I think we are seeing this negative effect. But in addition to all of this, we are forgetting to say that this hike in interest rate came at a very, very unusual time. It is very, very unusual and unorthodox to hike a benchmark interest rate so close to an election. We are just 30 days to an election. There's so much uncertainty. It's so difficult to anchor expectations in an environment of political uncertainty. So I think that is part of why there's such strong reactions to the recent hike in benchmark interest rates.
Yeah, so many reactions at this time. But all right, let's look at what's happening in the oil market now. We see prices still quite away from that $100 mark, even though we've had projections that $100 is going to happen again, this year. What's happening in that market?
No, prices got as high as $89 per barrel this week. Obviously, part of the reason is optimism about China's reopening, but oil prices have been volatile this week, mainly driven by two key factors. On the baseline, we have this optimism about reopening of China, which was positive for prices. But in the US, we are seeing two different factors are driving sentiment in the oil price in the United States. On one hand, we saw a smaller than expected buildup in US crude stock inventories, which kind of signals that some tightness in market supply. Data from Energy Information Administration from the US showed that crude stock inventories for last week increased by 500,000 barrels last week, as against expectations of an increase to about a million, a million barrels last week. So this shows that this signals some tightness. So that was supportive of prices. But on the other hand, some data coming out of the US, especially business activity, raised concerns. So data from US business activity showed a contraction in business activity in the US, which kind of raised concerns about a slowdown in economic activity and an economic a meltdown, which has implications for oil demand in the US. So those are the two factors at the moment driving oil prices. And beneath all of that is some optimism about the reopening of China.
And obviously the same sentiment will still be driving, what's happening in those markets with prices, next week. What are we expecting for oil prices and LNG prices next week?
Talking about oil, for oil prices next week, the biggest factor that will affect it is the US interest rate, right? So like I said, there's mixed reactions, there's mixed expectations about US interest rate, the pace of increase in US interest rate. Some analysts are forecasting 25 basis points, others are forecasting 50 basis points. It's very difficult to know which particular direction the US Fed is going to go. So that is going to be a big factor that would affect oil prices next week. Talking about LNG, the biggest factor is the weather at the moment. So initially, there was fears that in Europe in particular, there were fears that because of Europe trying to win itself from depending on Russia, that there was going to be issues around about rationing energy in Europe, as well as blackouts. But because we had a warmer than expected winter early on in December, that increased, first of all, that reduced demand for natural gas. It also increased the storage of natural gas. So at this time of the year, the amount of natural gas in storage is around 78% higher than what should be available around this time of the year. That was due to warmer than expected weather. Also, we are seeing huge imports coming from the US, coming from Canada, as well as the Middle East. So all of these factors are driving LNG prices. So next week, there's forecast that this cold snap we are seeing in Europe now would ease next week, even up until mid-February. And that is kind of like reducing the demand for LNG, together with huge storage and huge imports. That is why we are seeing the LNG prices are trend downwards at this time.
And obviously, investors globally looking out for that Fed meeting and how hard they're going to go with rate hikes for that meeting for 31st into February. But now let's look at cocoa production in Nigeria. It seems that's getting a boost.
Yeah, I mean, early rains coming out of the Harmattan season. Early rains has been supportive for cocoa production in Nigeria, but globally, we are seeing cocoa prices on delay due to conflicting or different drivers coming out of Africa. We know that Africa, West Africa in particular, have some of the biggest cocoa producers. So coming out of Ghana, for example, we are seeing concerns about supply because of the outbreak of swollen shoot virus in many of the cocoa growing regions. So that's raising concerns about output coming out of Ghana. But on the other hand, in Cameroon, in Ivory Coast, in Nigeria, we are seeing positive news about rains, positive news about larger than expected harvest are coming out of this country. So these two factors, while the decline in output or the expectations of a decline in output from Ghana is kind of raising cocoa prices, good news coming out of Ivory Coast, coming out of Cameroon, coming out of Nigeria is kind of capping the price increase. So those are the two factors driving cocoa prices at this time, Ladi.
And what about the domestic commodities market here?
Okay, for the domestic commodities, it's mostly good news in January because January is, dry January, right? Many people have spent a lot of their money in December, so January is kind of quiet.
It seems January wasn't that long.
Tell me about it. Because of there's so much activity. I mean, I can never believe that, next week is the end of January. Anyway, because of there's lower demand in January, plus effect of harvest, of the harvest season, and the Naira kind of strengthened over December coming into January. So we are seeing prices generally trend downwards. As a matter of fact, the price of a 50 kg bag of rice is down 13% to 38,000. 50 kg bag of flour is down 70% to 20,000 naira. A basket of tomatoes is down 38% to 16,000 naira. Peppers is also down around 48% to 25,000 naira. So generally, we are seeing prices trend down, which is positive. But they are mainly driven by three big factors. Like one is lower demand because of in January, typically January is associated with lower demand. Two is there's big supply. First of all, many of these commodities were stocked up for the festivities, so there's still kind of like an excess supply of those. And three is the Naira has strengthened over the holidays are coming into January, so that has also affected the import cost of some of these import-sensitive commodities like flour. And finally, we've seen the effect also of the harvest season. So those are the factors that are driving commodities market at this moment, Lad.
All right, thank you so much, Dr. Adesola Simoni, Senior Associate, Financial Derivatives Company. Thank you.
Thank you for having me.
All right, so after the break, we get a sense of what to expect as the National Bureau of Statistics releases the capital importation report, expecting that tomorrow. That's for the third quarter of 2022. That's our next conversation. Do stay with us.